If you go to youtube.com and you search for Community CPA, you'll find all of the webinars we have done for the past, I would say, 4 years. We started a YouTube channel in January of 2020. That's how long we have been on it, and about 3 to 4 times a week. So what we do is on Tuesday, we find a topic, and then on Saturday is a larger topic. So we got 2 new topics each week. And then during the week, we have other languages coming in to repeat the topic. So you will find Hispanic and Chinese webinars and in our system, but that repeat the English one. So I guess you don't have to listen to all 3 languages, even though you know all 3. Okay, I know a lot of you knows how to speak the second language or the third language. So today we want to figuring out our corporate estimated tax, right? So this is about our firm. Couple highlights. We are actually about 28 years old firm, and we have about 38 to 40 professionals. And here in our firm, we speak 10 different languages, and we have clients all over the country and about 12,000 clients. We have 4 branches currently, and the number 5 is Houston, Texas. So Houston, Texas is going to begin this year. So you can check us out. And we have on our website, it shows you Houston, Texas, what the building looks like. And we are right in the middle of the construction. So it's very exciting to be able to, operate one in the large metropolitan area. And I myself served on this Federal Advisory Committee in the past, which the committee is to provide advice to IRS. So that tells you how close I was working 3 years with a structured organization that providing input to IRS. Here is the 2 books I wrote in the past. The first one, 8 a.m., was done in 2019. Then I did the 10 a.m., finished it, published it in 2023 spring. Now I'm working on the 2 p.m., so we have 4 books in a row, so 2 p.m. and 6 p.m. So I hope you will see those books come out of my hand soon. No responsibility disclaimer. It is always true that digest the information you get from internet, and especially specific tax information. If you're going to use that for a major tax decision, just make sure you check with us before you use the knowledge. And what is the estimated tax? Why you talk about estimated tax? So in the IRS system, what they have implemented something is called a voluntary tax payment. So the IRS encourage people to pay taxes ahead of time, not when the time comes and you file, you owe, and you pay. So what IRS basically saying is that if you have already owed taxes once in your tax filing, then we don't want you to do that again. Start doing estimate taxes. Then you may say that, well, then how much do I do? Can I do just $1? No, there is a calculation to it. That is what I want to explain to you today. But, generally speaking, estimated tax is a periodic payment made to cover income tax liability based on your reported income for a specific period. So let's say if your company is a calendar year company, so now we're in June, so by December, you will finish this year, right? So you would pay estimated taxes already in April, and now you are going to pay the second estimated tax payment in June. Then you may ask me that, how do I know I need to pay estimated tax? So there are 4 ways to calculate, but the most common sense, essential ways of doing that is very simple. You just look at your last year's. If you don't have a last year, you're okay to not pay estimated tax. But if you have last year already and you owe taxes, ladies and gentlemen, you need to pay estimated tax. So how do you calculate that? typically, and you want to pay 25% of your total taxes that you owe. So that's kind of the threshold I'm giving you. And these payments are necessary for income that is not subject to automatic withholding, right? Automatic withholding, what I am talking about here is more like your payroll taxes stuff, so those are not these. And so-called estimated tax is estimated income tax for your company. So payroll taxes draw, done, finished every quarter, every month maybe, but your estimated tax is very voluntary. It is you need to do it. IRS would not really have a tool to remind you, but what they can do is to penalize you. They penalize you a big time. They penalize you on the interest calculated from the first day of the year, and then they give you a penalty rate. It's about 15%. So corporations, for businesses, you must make estimated tax payment if you expect to owe taxes more than $500. So of course, if you have a loss, no big deal. You don't need to pay estimated tax. But if you have any money and you're going to make a profit, yeah, you want to think about estimated tax right away. And the prior year liability, if your tax liability was more than zero in the prior year, you need to pay estimated tax. Does that make perfect sense, right? So question about quarterly estimated tax. The next quarterly estimated tax deadline is June 17, 2024. We're in June. Normally it's June 15, but because of the weekend it went to the 17. So make sure that you know that due date. You want your business to pay minimum amount of estimated tax without triggering penalty for underpayment of estimated tax. Yes, underpayment of estimated tax is a name of a penalty. There's many penalties, right? If you search our webinar, we talk about the penalty. Like you have a late filing penalty, and fail to do estimated tax penalty, and fail to pay tax on time penalty. So there's all kind of penalty, accuracy related penalty. Man, I mean that. If you put all the penalty together, it's going to fill up your jars. So it's a lot of penalty. But here we're talking about trying to avoid paying these estimated tax non-payment penalty. And four possible options. So you may say that, oh yeah, Ying, you said that I'm going to pay I'm going to pay estimated tax, but what are the ways I can calculate it? So there's only four methods: current year method, preceding year method, annualized income method, and the seasonal income method. And I will tell you that out of these four methods, most of the people are using the first two. So the annualized and the seasonal, we'll take a look at it. So the first one, current year method. Under this option, a corporation can avoid estimated tax payment by paying 25% of the tax shown on the current year's return. 4 installment, right? Because when you pay the quarterly estimated, it's a 4 quarterly payment. So these 4 payments come in April 15, June 15, September 15, and December 15. And if you are a December year end, right? These are the 4. And you notice that the April 15 sort of has a little longer time from January to April 15. You got extra 15 days to decide how much to pay for the first quarter. But then the second, third, and fourth quarter didn't give you that, right? They just come in on June, September, December. So this is what I want you to remember. So you don't think that, oh yeah, my estimated tax is due on July 15. That's not for the corporation, right? Those are the stuff you remember. That may be for your 1040, but not for your corporation. And if a due date falls on Saturday, Sunday, or a legal holiday, the payment is due the following business day, just like right now. It's not June 15, it's June 17. So this is a current year method. What it says is that if you are, you know how corporations sometimes also have a year end, could be on March 30th. Of 2024 is their year end. So you may be in this current year, current calendar year, you maybe are doing your tax filing. So if you have the tax return, you know how much taxes you owe. Take 25% of that, start paying down the estimate for April 15 and so on and so on, right? So this is a current year method. You use current year information and you figure out what your income gonna be, and then you make that estimated tax calculation. Preceding year method is different. In this option, the corporation can avoid paying estimated underpayment penalty by paying 25% of the tax shown on the return for the preceding tax year. Okay, so what does that mean is right now we are in June, so most likely you have already finished your C corporation tax filing back in March, and you actually know in 2023 how much taxes you paid. Maybe you paid $100 taxes, so that means 25% of $100, it would come in divided by 4, and that would be paid on each quarter. So you're gonna pay $20. You're gonna pay $25 in April 15, another $25 on June 15, $25 in September 15 and December 15. So that is how you calculate the preceding year's method. However, there's a certain company that the restriction placed on certain company with taxable income of over $1 million. So if your taxable income is over $1 million and or more in the last 3 tax years, if you add them together, you divide it by 3, and then this kind of company can only use preceding method to determine their first installment payment, which is the April 15 one. So what it says that if you're a large corporation and this is the only method you should use, you should not be going on the current year one we just mentioned. So in addition, this method isn't available to corporation with tax return that was for less than 12 months. So if you filed a short year, for example, your corporation maybe started in November of 2023, you filed just 2 months, and then of course you don't have taxable income, or taxable income was really short, really small, then these estimated tax may not be the right estimation, right? 25% of that would not be right. So in that case, this method is not available. You need to use another method. You see how whatever the government is doing, they're just trying to make sure that in any case, you got your estimated tax in. They don't want you to pay taxes when you file your taxes. The government really want you to get a refund when you file your taxes. They want you to overpay it. Just pay it, right? So that's how it works. And then the third one is annualized income method. So annualized income method, under this option, a corporation can avoid paying the penalties if it pays its annualized taxes in quarterly installment. So annualized typically is computed on the basis of the corporation's taxable income for the months in the tax year ending before the due date of the installment. So let's say installment is April 15, right? So you will calculate the month from January to March. Those are the months you can calculate to figure out based on the first 3 months, you figure out 12 months, right? Then let's say the first 3 months you made $10. So the 12 months, that means you're gonna make $40, right? So that $40, you will use that to calculate your estimated tax. So that is what they mean by annualize the income method. They mean before your installment due date, they want you to calculate the annualized income, then figure out how much of the installment you need to pay. And it is designed to limit underpayment and the corresponding underpayment penalties related to uneven payment, because obviously sometimes your company, maybe the first 3 months your construction company, you didn't even have any income. And then April, May, June comes and you make more income. So you're always gonna do those kind of annualized income. You take January to June and then you annualize it by ×2. Then you figure out your installment payment that is gonna go to the IRS. So that's annualized. Then the last one is also, I would say, the most complex one, because you have to get get into a certain qualification to use this. This is a seasonal income method. Under this method, The corporation with reoccurring seasonal pattern of taxable income can annualize income by assuming the income earned in the current year is earned in the same pattern as in the preceding years. So that means the prior year, right? There is somewhat complicated mathematical test that corporation must pass in order to establish the seasonal qualification, so you can use seasonal income method to calculate your estimate. And you remember that for a corporation, if you are seasonal, you really should have upgraded your fiscal year method from the calendar year. So let's say you're a construction company and you start getting busy in April and you finish most of your job in October, and your year, and when you end your year in December, you just give yourself 3 months time to really spend money, right? But in reality, January to March, you're really not busy either. So what the tax professional would tell you that you should start the year from April. You run all the way to March. So you give your money to the top of the year and then you spend them on the bottom of the year. By the time you're ready to file taxes, and your net profit would be low because you are in the right pattern for your seasonal income. So same thing with estimated tax, and you want to coordinate with your seasonal income method. So in the first two quarters, from April to October period, this is where you want to calculate your taxable income, but you also want to consider your next 6 months. You don't make that much income. So what is your overall taxable income situation? Then you can use that to calculate what would be your estimated tax. The goal is, it doesn't matter what method you use. When you file your corporation tax return, you do not want to be in the paying tax position. That's the bottom line. Okay, folks? So you want to remember there's method you can use and to be more reasonable in terms of calculating your estimated tax. We're not trying to calculate more estimated tax for you. We are just trying to calculate the most reasonable amount that you would use to pay taxes. So when the tax season comes, you file your taxes, you're like, perfect, I don't owe, I also don't need to pay. But even if you owe small amount, $10, $100, and not gonna be $100,000, right? So that's why we want to spend some time to talk about estimated tax, because it is a important tax actions you need to take every quarter. And same rule applies to 1040. So I'm talking about corporation, but for 1040, it's same. You need to calculate what you have, what you need to pay as an estimated tax. If you already owe taxes last year, and you're gonna owe in 2024 again, yeah, you're gonna pay estimated tax penalty. And even though you are paying it on time before April 15. All right, final notes. A corporation can switch among the 4 methods we were talking about today. And during any tax year, giving tax years, you can switch. You can do this way, that way, whichever way, right? And remember that the estimated tax helps to cover not only income tax, but also other tax like self-employment tax, alternative minimum tax. So, the best way to get the number for the estimated tax is not you times 21%. No, you want your tax professional to actually calculate that for you to see whether you triggered alternative minimum tax as well. And failing to pay enough through withholding, how sometimes some taxes is done via payroll, and so you got your W-2 and stuff, but you didn't really withhold enough, you end up paying taxes. Those are also result in estimated tax payment. I know my final notes sort of blend in the 1040 side of things, but it is the same theory. When you need to pay taxes again in the second year, and you already incurred estimated tax. All right. desire to know more? Yes, desire to know more. You can search our YouTube channel and learn it there. And you can also come to our website, and this is the partner's name, and you can click any one of us to book appointment with us. And here is our website, and also Catherine at communitycpa.com. You can email her to express your desire to hear what topic. So we will make that into our Tuesday and Saturday, Wednesday, Friday webinar. And our office opens Monday to Saturday. Yes, not Friday, Saturday. We open 6 days a week, 8:30 to 5:30. And of course, we are here at 3 p.m. is always our webinar time. I hope to see you again. And thank you for spending your time with me. I always really appreciate that. Thank you.